Good afternoon and welcome to the Kill and Go podcast for Thursday, the 24th of March. So this is a short week. It's been dominated by Brussels and events there. So it's led us to revisit very quickly the implication of Brexit, where the chances of that has probably risen this week. So probability around a Brexit is at 30% at the moment in markets. The consensus base case in the eventuality of us leaving Europe is European equities fall around 10 to 15%. That's a PE derating of 10% and an earnings derating of between 5 and 10%. Equally, you'd see pretty significant sterling weakness, and we're already seeing some of that. The sterling dollar number would in consensus view, would potentially reach around 120 against the dollar. That's around 15% downside. And clearly we'd see increased political risk in Europe, with the UK galvanising some of the peripheral political parties to leave Europe. So protect against that, we do look at global defensives and structural stories as probably a safe haven in this kind of market, and particularly the US denominated stocks as a good hedge for that currency risk. So we're just revisiting the relative underperformance that we talked about last week in some of these names. So in this table, it's not particularly consumer friendly, but we've got 8 names: Accenture, Nike, Apple, Walt Disney, Amazon, Facebook, Alphabet and Visa. These are all companies that we think have got great above GDP growth rates for the next 5 years, and we've got good visibility about that growth rate going out over that period. Now, a lot of these stocks have had good years over the last 12 months. We've got the total return here of these businesses, and they have absolutely outperformed the market, with the exception of Apple and Walt Disney. But we feel it's not too late to be buying these stories, and I think the most important thing to be looking at is what's happened to the rating over the last 12 months. And if you look at this column, we can actually see that those ratings have remained relatively static, or in some cases have devalued quite significantly. So if you look at a stock like Facebook, which had a great year last year, up around 33% in share price, but the earnings grew 36%. So buying it today, when a lot of that earnings risk has de-risked, because we've got more transparency and more knowledge about how they're scaling their core platform, you're actually buying it at a 3.5% cheaper valuation than you would have been if you'd been buying it 12 months ago. And we think that shouldn't be overlooked, particularly during a period where you've got very low growth in the economy. You've got a lot of uncertainty with emerging market currencies, with commodities. You've got a lot of structural change with really pointed devalue or lowering of return on equities in certain industries. So these businesses that are managing to grow very quickly through this difficult environment, we think are more likely to be re-rated this year than de-rated. And if we look at 2018, which isn't a long way out, we're seeing very reasonable price to earnings multiples for these stocks, not significant premiums to the market multiple. So we definitely think you should be revisiting these names within the portfolio. So just looking at the week ahead, it's a relatively quiet week. It's a shortened week for Easter. There aren't any Killik and Co stocks reporting next week. So that's it from me. Have a good Easter weekend. Thanks very much for listening.